I think that market participants, let's say, are starting to anticipate the idea of an economy that is supported by its own inherent growth engines and not reliant on Federal Reserve stimulus as far as the eye can see. I do think we're getting closer to the moment where the Fed's going to have to make an offhanded remark about tapering asset purchases, which I think would be appropriate. Unfortunately, there's no great way to come out and say it. During the last taper tantrum in 2013, Bernanke kind of snuck it in there during congressional testimony, not during a Fed meeting. The market freaked out, and it was really the highest multiple growth stocks that got hit the hardest. And that's exactly what's going to happen this time. And I think market participants are sort of starting to sniff that out. So treasuries have bottomed recently. Gold has bottomed recently. The yen has bottomed recently. These are all risk-off trades. You do have this momentum in financials and cyclicals. I think that should hold up okay. But the growth stocks, the things that are most susceptible to a tapering of asset purchases and then a subsequent eventual rise in rates, are really the epicenter of the damage. I was looking at the ARK ETFs, Judge. Nothing to do with like ARK, like they're not doing a good job, ARK the company, but just that kind of that theme, right? That idea of who cares about cash flow? Let's just buy user growth or whatever. The flagship ARK fund is down 29% from its high. Yeah. That's a massive drawdown.
More.
And of
Even
course,
more now,
right?
Most
of the money came in at the top.
I don't know if you have a monitor, our air where you're sitting and the way you're looking at things, but we're showing it on the screen right now. It's down 32.3% off of its year high. Your point is well taken. So what you're essentially saying, Josh, is the market's walking itself up to a taper tantrum of some kind.
Yeah, it's going to happen, and it won't be very different from last year. But I think it's healthy. It should happen. I'd rather do it sooner than later. If you just, really quickly, if you go back and look at what that was like for investors, May and June were pretty disastrous for stocks. Rates spiked. But then by July, they were already like reassuring us and walking things back, and the markets were able to stabilize. They did that 7 months in advance of the actual start of tapering, which was officially announced December of that year of 2013. They spent all of 2014 gradually buying less assets each month, and then you didn't get the first rate hike until December of 14. So almost 20 months of prepping markets for that first rate hike. Like, I feel like that process probably has to start this summer if you keep getting blowout employment numbers and job openings skyrocket and housing activity exceeding any other calendar year outside of 2006. If this is what the pace of the real economy is, and we think it's somewhat sustainable, it's not appropriate to buy $40 billion worth of mortgage bonds and $80 billion worth of treasuries every month without end. It makes no sense.
That's exactly what Rick Reeder has told us within the last couple of weeks.
Well, Rick is smart.
Yeah. Court, I have this viewer question in front of me that came in a few moments ago, and I think it's a good one because I think a lot of people are asking themselves this or want advice from people like you. When the 10-year was rising, says Kelly from Columbus, Ohio, tech was systematically tanking, right? We saw that and we talked about it every day. As yields have lowered and stabilized, which they are lower again today, I think 158, something like that, tech is still dropping. So if higher yields were causing tech to sell off, why are lower yields causing tech to continue to sell off?
Well, great to see you guys today, of course, and I think it's a really interesting question. And I think in theory of economics, right, and what we know about how yield should impact growth stocks, the way that it reacted initially is what you would expect. What you're seeing now, you'd say, why in the world is this happening? And that's what the viewer's saying. you have to look beyond the surface of kind of how yields are impacting it, because that's not the only thing that impacts these growth stocks, these large tech names. When you think about raising cash or when large institutions need to get liquidity, where are they going to go? They're going to go to the most liquid stocks. And that's what you see in these big mega cap names. And so every time they need to raise cash to do something else, if they want to rebalance, if they want to do anything, they're pulling it from Apple, they're pulling it from Facebook. Those names have a disproportionate weight in overwhelming majority of portfolios. And so when it comes time for liquidity needs, that's where investors are going. And so I personally, as you know, Scott, am a heavy believer in tech, especially some of those big mega cap tech names that are well positioned in this marketplace for the future. Unfortunately, in the short term, whenever you see, again, like a Facebook provide knockout earnings, you're going to see people take money off the table. Same thing for Apple. And so, you know, yields are impacting growth stocks to a certain extent, as they should potentially, and that's a debate in and of itself that you know, we can have one day. But ultimately, it's not just yields and what's happening with the 10-year that's causing some of the turmoil that you're seeing in the stock market, particularly around those mega cap growth names.